Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone. Welcome to today's edition of our AWA Market Minute. Super excited to be with all of our guests today. With me as always is Scott Hoxer. We'll introduce our guest panelists in a minute here. But Scott, the seasons are changing.
Yes.
It's getting cold.
Yep.
I think winter is officially upon us. My son got up this morning, took a shower, put on a messy jersey, messy like the soccer player, and messy shorts. And he was ready to go. He said, play soccer for recess. And I said, dude, it's like 30 degrees outside. And I had to walk him outside in order to get him to believe me. He needed to put on pants and a coat.
And I'll bet he didn't listen to you if he's like my kids.
There was some coaxing I needed to do to get him to get behind the idea. With the season changed, I noticed something happened to my car the other day. I was driving and one of those little warning lights showed up on my dashboard that said your tire pressure is low in the front left tire. So I had to pull over and fill up that tire and get some air in there to repressurize it. And sure enough, about a week later, with the temperature changed again, I do the exact same thing with my front right tire, get some more air in there to get the PSI to the correct pressure. And it got me thinking a little bit about, I bet this spring, as temperatures change again, I'll have to let some air out of the tires. While I didn't abandon my vehicle on the side of the road because of, the conditions, and I didn't change my destination where I was headed, I did have to make some minor adjustments to the vehicle in order to ensure it was driving at optimal performance. And my kids tell me all the time I speak in parable, and it may be true. I like to wax poetic, but this is an analogy for me of retirement and our investing models and financial planning that goes into our retirement. When we talk about conditions changing, we don't talk about abandoning our vehicle, which would be our planning. We don't talk about changing our destination, which would be our financial retirement goals. We talk about making minor adjustments to the vehicle in order to optimize performance and ensure that we can get safely to our destination without any hiccups. Go ahead.
Yeah, and to further that analogy, Paul, I have a few teenage kids who I've had to teach how to drive, and as we go down the freeway and need to make subtle lane changes, they tend to jerk the wheel a little bit, and that's not what we're talking about. We're talking about minor adjustments.
Minor adjustments. Yeah, we're not abandoning the vehicle, which is our planning. We're not changing our destination, which is our retirement goals. We're making minor tweaks, minor adjustments in order to accommodate for the change in the conditions, right? And so what are these conditions today? We're going to talk a little bit about this, but as we do, I'd like to bring on our guest panelists, which happen to be two of our favorite people ever. We've got Mason Page and Jaron Monk, and all of our clients on the call today, they know Mason and Jaron well, two other advisors here at the firm, and both members of our investment committee here at Alliance Wealth Advisors. And our investment committee gets together regularly to discuss kind of what's going on in the market today. So Jaron, Mason, thank you for joining us.
Yep. Thank you. Thanks for being here, or for having us here.
Yeah, so let's get Scott to go ahead and talk to us a little bit about what's going on, kind of the market watch right now.
Yeah, so as we kind of near the end of the year, we thought it would be constructive to kind of walk the audience here through kind of where markets are at today and some of the key themes that we're seeing. So if we can, maybe look at just a few slides here, I think we can, kind of talk through what we're seeing in the markets. Obviously, top of mind for everyone right now is what's going on with geopolitics, with the stuff in ongoing issues in Ukraine, with the turmoil in the Middle East. how does that impact my investments? That's obviously top of mind. We also look at the economic data, which is kind of lost in the popular press, but a lot of the economic data is pretty solid. We're seeing good GDP numbers. Corporate earnings have been pretty resilient. Inflation has been ticking down. And so we have kind of a tale of kind of two things. On the one hand, economic data isn't bad, but on the other hand, some of these geopolitical things are alarming. And so that's the nature of what we're seeing today.
I saw a metric the other day that was, a graph that measures, they call it the fear to greed scale, right? And it kind of measures consumer sentiment everywhere from fear to greed, fear of, things falling apart, the sky is falling, and greed saying everything is perfect and we can't miss. And then the market actually is impacted pretty heavily by this consumer sentiment of fear to greed. And we've ticked down from fear to extreme fear. We're just right between those two, and it's the first time we've hit those that scale in a little while. So there is some sentiment out there of some extreme fear.
Yeah, and I think there's a few kind of data points that speak to this. Andrew, can you share my slides there? Perfect. So I think this one's super interesting because while these geopolitical events are super alarming and super concerning on a human level, and it does maybe seem a little callous to talk about them in an investment context, as investors, we need to have awareness of kind of how these impact our portfolios. And so this particular chart goes back and says, hey, when we have major geopolitical events, what is the net effect of the market, a few days later, a week later, a month later? And you can see in this chart, things like the Cuban Missile Crisis, Pearl Harbor, the 9/11 attacks. I would argue Pearl Harbor, 9/11, the Cuban Missile Crisis. I mean, those are heavy items. And even, against the backdrop of those, on average, a month later, markets are basically flat. 6 months later, markets are up slightly. A year later, markets are up a little bit on average. And so, there's obviously always a, exception to the rule, but generally speaking, markets do have a capacity to absorb geopolitical events. That being said, we're not out of the woods yet. We could continue to see some choppiness as these geopolitical events evolve. To your point, Paul, about kind of sentiment and how people view things, what this shows, the blue line here shows kind of positive market sentiment, and the red line shows negative market sentiment. And we've seen a huge surge in negative market sentiment. This is pretty counterintuitive, though. When, it's the old Warren Buffett adage, be fearful when others are greedy, be greedy when others are fearful. And when we see deep pessimism like we see today, that's often a harbinger of things being quite a bit better in the coming months. And so as sentiment, gets to kind of really negative levels, a lot of times that's a positive indicator for markets going forward.
Well, and if you think about it, like the timing of our emotions, it takes time for us to process, these bear markets. And so, it's not something that generally, like in COVID, when we saw that big sell-off in the first part of 2020, people didn't have time to really react before the market was already recovering. And now we've experienced kind of a pretty long duration bear market. So it makes sense to me why, even with, some glasses half full, information out there, there's still a sentiment that says, I think I'm just tired.
Yeah. No, there's definitely fatigue.
Mason, were you going to say something?
Well, yeah. So one of the things I think is super interesting about this is that consumer sentiment was relatively low just a couple months ago. So through the end of July, it was lower than what it's historically been. And then from August to now, we have had this fear increase quite a bit. I think that's right around 20% there, where it just has continued to increase. And, that was before the situation with Israel that's going on, the conflict, the fighting over there. And so it was, this year, people started to be less fearful for the first half of the year. And then the last couple months, it spiked right back up.
Yeah.
And so we see how fickle this is, how fickle people can turn when it comes to the sentiment.
Yeah, and I agree with the sentiment that there is fatigue that's very much set in, and when we do have these periods of prolonged markets that aren't particularly good, it's important, I think, to zoom out and keep the long-term perspective as far as what markets do historically. This particular chart goes back to the 1950s. We could extend it back to the 1940s, and it would show kind of the same data. But what you're looking at here is the blue indicates bull markets or positive markets. The red indicates bear markets or negative markets. And this shows the amplitude and duration of bull markets versus bear markets. And you can see the highs and the length of bull markets are much, much more significant than the, depth of some of these negative markets. And that's why we all invest. The price of admission for investing is some volatility, but we do it because it's an endeavor where the odds are very, very much stacked in our favor. So I think it's important when we do have prolonged periods of, not particularly good markets to keep in mind that this is kind of the long-term trend.
Yeah, and I think it's interesting. I'll play devil's advocate for a minute here because, we are advocates for our clients, right? We're advocates for their retirement. And one of the conversations that, people push back on when they see this kind of chart is, yeah, but I'm not 35 anymore, right? I'm not able to withstand a major market correction when I'm in my retirement. And while you're not wrong, we need to understand what is the financial plan around your retirement and how does this graph fit into that plan? Because these are all facts that exist and variables that we have to account for. We do have to account for this variable. I understand, you might not be 35 anymore, but this is still the reality of the market.
And one thing I'd add to that really quick is we talked about sentiment, and then we're looking at this graph here. We did just go through a pretty severe bear market. And what a lot of people don't realize is the market is a leading indicator. So a lot of that sentiment, a lot of that fear will show what investors think is going to happen. And so the market tries to price that in beforehand. And if you're looking at this graph, we're already showing an uptick throughout this year, despite a lot of that negative sentiment that's been coming to fruition.
Yeah. Yep, that's a good way to say that.
So one other theme, we'll touch briefly on right here, and then perhaps at the end, if we have time, we'll cover it in a little greater detail. But another theme we've seen is ongoing turmoil with interest rates and bonds, and it's led some people to wonder, boy, do bonds play a role in my portfolio anymore in light of what happened to bonds in 2022 and in light of the interest rates which have continued to tick upward. What this chart shows is just how infrequent it is to actually have bonds go down in value. In the lower left-hand quadrant there, what you see is the 4 periods of time where bonds have actually declined in value over a calendar year. The purple dot there that's at the very lowest, that's 2022, the worst year in history for bonds. And the beauty of markets is we do have mean reversion. And what that means is when something really falls precipitously, it often moves pretty significantly in the other direction. And so, bonds in particular offer some opportunities today that perhaps they didn't in prior times. And just to conclude kind of some of this market overview, if you will, given the fact that we do have, some geopolitical uncertainty, given the fact that we have some political and policy uncertainty as far as what that looks like going forward, and given that, while the economic data has been pretty solid, that's not always a given either. The overall conviction with direction for markets and, what's going to potentially surge, that's not as high today as perhaps that is in other times. What this chart shows is when we have high conviction, when we're over to the right on the bottom axis, that means that we can get relatively concentrated with our portfolios. On the other hand, when conviction isn't quite as high, that's perhaps where we hedge our bets a little bit and diversify a little bit further.
And that's a great lead into how I want to kind of frame the rest of this conversation. And what that looks like is, we have to have a financial plan in retirement. We understand that the market is something that we don't get to control. And for the most part, it's something that, we have to utilize in order to maintain the growth of our portfolios. So let's talk a little bit about kind of the financial planning that exists within our clients' portfolios. Everybody has a household, and they maintain that household with fixed income sources. Most of our clients might have a pension. generally everybody has Social Security. And when we add up these fixed income sources of pensions and Social Security, this sample household has about $8,000 a month coming in, or $96,000 a year, to help maintain their standard of living. And then every year, there's an amount of consumption that family will spend in order to buy their lifestyle. And we're going to use the example of $144,000 a year annually for this particular family. Now, I'll pause just to note here, a lot of times people will try to build their budget around their cash flow. And while I think that's a great intention, the reality is that mostly we don't spend just our monthly cash flow in any given month, because you don't account for that vacation to Hawaii or that extra trip back east to go see the grandkids, or Christmas, right? Or the new tires and the water heater. So those are things that we have to kind of budget around that aren't regular monthly distribution needs. And generally speaking, people are going to spend a little more than that. So, and we have to have a little COLA, obviously, on that as well. So what we have is these reserve assets that people will have accrued during their working years. And those reserve assets, generally would be some kind of a retirement 401k or IRA, Roth account. Sometimes it's just after-tax brokerage money that they've saved. And in this case, I'll use the example of, $1.1 million. We don't just take that money and go and invest it, though. A good retirement plan has, an appropriate diversification in not just the different investments, but the style of investments and the purpose of investments. And here at Alliance Wealth, you're all familiar with the term smart retirement. And so a smart retirement here is we break up that money into various buckets. And some of those buckets we color code as gray, green, yellow, and red. Now, each of those buckets has a corresponding kind of strength and weakness based on a criteria, right? So our spending bucket, you can see that criteria is really strong in the first category, which is liquidity, right? The second category is contract guarantees. The third category is volatility protection. And the last category is growth potential. So in our spending bucket, the money that we would keep in our bank or credit union, we're giving up some growth potential in order to maximize the other three. Now, when Scott goes and explains kind of market conditions and things that we're up against, that's primarily going to impact our red bucket, that farthest bucket, right? Where the growth potential is the highest and the volatility protection is the lowest. So we will experience periods of emotional ups and emotional downs inside that red bucket. That is to be expected. It is literally part of the planning, is that we know the red bucket will be exposed to periods of ups and periods of downs, but over time, the expectation of those assets would be that they would outperform, the other macro investment opportunities that we might be invested in. Has that played itself out mathematically, Scott? I mean, is there an argument we can make that says that doesn't work over a 50-year period of time?
No, there's not.
Yep.
Yeah.
So when people say that, hey, listen, I'm not 35 anymore, I can't afford to put everything there, we agree, and we're wholeheartedly behind that sentiment. Not everything should ever always be in that red bucket. That was a lot of negatives. But you should not put everything in that red bucket when you invest. We have a yellow bucket intentionally designed to try to be more tactical in nature, and it is looking at the market as a whole and looking more at the macro information out there of the market, with trying to win by not losing. It's trying to protect the drawdowns of market volatility. It's trying to say, hey, we can't be in a position where we just ride down a 2008 financial crisis and hope that we've got more than enough time to make up the loss later in retirement. That yellow bucket is designed to say, no, that's not going to be what we're going to do. We are going to try to protect those drawdowns and keep our principal mostly intact. And the green bucket, that would be like an insurance product where it's contract guarantees and volatility protection are fixed, right? But what we're giving up there is some of our liquidity in order to get a little better rate of return than we would in a spending environment, okay? Now, this particular sample, we also had a couple pieces of property, and what we determined was they needed to draw $84,000 a year out of their reserve assets in order to pay for their consumption. Now, where do we get $84,000? Well, there's a 20% haircut that they had to plan on every year for taxes. So when you take 20% out of the $96,000 in fixed income and $84,000 in distributions from our reserve assets, we end up with $144,000 of annual spend money. Now, these guys were able to get about $18,000 off of a rental property, so the other $66,000 were distributions from their reserve assets. And what we always teach is you live out of that spending bucket, right? When you take that $66,000, it comes out of our spending bucket. And then, what do we do to refill that spending bucket?
Yeah, we take distributions from whatever makes the most sense at a given time, right? Like, one of the beauties here is that we're not beholden to one specific bucket. It's whatever makes the most sense at a given time.
So we don't have to have a crystal ball, right? We don't have to make a guess. We can look at what's happening in real time and make a decision in real time as to whether or not it makes sense to sell some shares of Amazon to refill our spending bucket, or hold on to those shares of Amazon and take some of the cash out of the yellow bucket or green bucket.
Paul, and a good example was last year. Last year, we've already, touched on market volatility, bonds had a tough year, that type of stuff. But dividend paying stocks did relatively well last year. And so we had some unique opportunities to be very specific about where we took distributions from in a tougher market environment.
Yeah, that's exactly right. And we didn't have to guess. We could actually watch in real time what was happening to dividend paying stocks and knew that would be an excellent source for replacing some of the spending buckets of our clients. Now, what we want to spend just a minute on, is what does it look like if we feel that now might be an opportunity to take some air out of the tires, right? Because we get conversations periodically in these kind of environments where people are very nervous, and they'll say, can I let some air out of the tires? And the answer is, this is always going to be your money, and our job as fiduciaries will always be to teach you and to educate you. We are totally agnostic when it comes to specifics of what you do. We just want to be doing what's in your best interest at all times. And right now, there is an interesting opportunity because the Federal Reserve continues to push interest rates, and we live in this very inflation-heavy environment. Some of these protected buckets are doing things today that we haven't seen done in decades, and this presents an interesting opportunity that could apply to some people who say is now a good time to start letting some air out of the tires. And so in this example, I'll just kind of show you, if we took some money out of a yellow bucket and some money out of a red bucket and rebalanced those slightly, we would have the opportunity to take that to like an insurance type vehicle, an annuity type vehicle, with a guaranteed fixed income result. And what that looks like is in this situation, would for most average retirees would be about a $40,000 per year lifetime income. I want you to think of this like a pension, right? Where once that income stream turns on from the insurance company, it doesn't come off again until you die, right? And in many cases, this can be for both spouses, and so it can be in two lives. Why does this work for some people? I'll explain it as we go back to the bigger picture here. Let me just draw on the bigger picture here. What we've done now is we've said this part of our income is gone up now. We've added another fixed income source to the plan, which has increased our total to $10,000 a month. We haven't changed our consumption number at all, but what we did change was our amount of distributions we needed to take. And as a result of reducing the amount of distributions we needed to take, we let some air out of the tires, and we became a little less nervous about market volatility. Where have you guys seen this work in any of your client interactions, meetings?
Yeah, Paul, we had one recently where we've got a couple who is getting very close to retirement, and in their situation, they wanted to de-risk a little bit and look for some opportunities. And so we were able to take some money out of the yellow and red buckets and reposition it so that now they're going to have an additional source of income in retirement that is guaranteed as long as one of the two of them are living. It just continues to pay out as long as one of the two of them are living. And so it alleviates some of those withdrawal distributions that they'll need to make. Which, going back to Scott's slides that he showed just a couple minutes ago, we saw that slide that shows the growth of the market over time in different bull markets. And now by pulling some of that money out of red and yellow, it allows for their monthly distributions to be met, and allow the red and yellow money that's left in the account to grow and do its thing.
Yeah. That's awesome. And we've seen this with a number of, clients who have specifically said, look, I'm at a place in my retirement where I'm ready to let some pressure out of the tires. But I want to just make sure we emphasize, this is not abandoning the vehicle. This is not changing the goal or the destination we're headed to in retirement. The planning is consistent and constant. The objective of maximizing our fulfillment and happiness in retirement by maintaining a strong standard of living, the ability to travel and make the purchases that are important to you and be generous with your family, none of those things have changed here. All we're doing is saying, can we make some minor adjustments? And given today's interest rate environment, there's an opportunity here that didn't exist even just 3, 4, 5 years ago that exists today. So to the extent that this is one option to de-risk and let some air out of the tires, it is there and available.
I think that's an important point, Paul. And I also think it's important for the audience to know the letting out of the air out of the tires isn't necessarily going to be right for everyone. Some people shrug off market volatility, and if your goal is to maximize your number over the course of 20 years, the red and yellow money is going to remain the best vehicle to do that over time. If, however, you find yourself in the camp where you get a pit in your stomach and some of these bumpy days in the market really make you anxious, this might be something that makes sense.
Yeah, I love that. We're not abandoning the notion that over time that red bucket will be our best performance vehicle, and we know that many of our clients have sufficient cash flow from fixed income sources already, and for them this particular de-risking strategy wouldn't be very effective because over time it would play out to actually reduce their overall legacy to their families. So,
and I would add to that, there's more than one way to kind of alleviate that pressure. So simply just moving some of those funds from a growth bucket to a defensive can work out really well for some of our clients. Kind of the aspect of that would be, we're not chasing the puck, so to speak. We're going to where the puck's going to be. So if you're able to position more of that into bonds, which really do have a really good yield in today's environment, that may still alleviate a lot of that pressure that someone's been experiencing in their portfolio.
Yeah, I love that. Scott, speak to that a little bit too. Maybe what are some of the yields we can expect given today's market conditions?
Yeah, absolutely. So to your earlier point, Paul, we're seeing yields that we haven't seen for many years on high quality corporate bonds, for example. 6.5% is kind of where those yields are at right now. More lower non-investment grade bonds, about 7.5% is what we're seeing. U.S. Treasury bonds have attractive yields, and so there's a number of interest rate vehicles out there that just didn't exist previously. And why that's compelling is, regardless of what the price of the underlying bond does, you're collecting payments that are very attractive. And so there's an opportunity there, to Jaren's point, that exists today that maybe didn't previously. And for someone who isn't in need of income per se, but does want to de-risk the portfolio and still have attractive yields while doing so, bonds have become much more attractive today.
And I think it's probably worth pointing out here too, because I think a lot of times bonds can be confusing, right? Bonds can be kind of a complicated investment vehicle for people that are feeling their way through. And when we talk about, bonds, you can own them inside of a basket. We would call that a mutual fund of bonds. Or you can own those bonds directly. They're in your portfolio. The actual individual issuer of the bond is in your portfolio. And there's a difference there. The basket of bonds in a mutual fund, we are subject to, some significant potential for market value adjusting given interest rate fluctuations. and the value of what we own will go up and down with interest rate fluctuations. And it's an inverse relationship. If interest rates are going up, our basket of bonds and that mutual fund or ETF will drop down. And that's what we've experienced. That's why 2022 was such a horrendous year for the bond market. But if we own those bonds directly, the risk that we face is now default risk, because if we own the bond directly, the bond will yield whatever its yield has been given, but it will also mature at face value, right? So long as we have a plan in place there, the price change of that bond that we hold directly isn't going to be as concerning, because it will mature at its face value. Correct?
Yeah, that's absolutely right. And just to carry that example a little further, Paul, if you have a newly issued bond today and you buy $10,000 worth of that bond and it's paying 6.5% interest, you collect $650 every single year on that bond. And then when that bond matures, you get your $10,000 back.
That's right. So Scott, given, again, kind of Jaron made the comment, like not chasing the puck, but heading to where the puck might be next, and that way we kind of make an anticipation move, not chasing the hot dot. Given last year's kind of bond market, would this be a reasonable opportunity this year to say, maybe if I want to de-risk and let some air out of the tires, bonds might be a good option for me?
I think so. Mathematically, you just look and say, hey, where can bonds go from here? Last year, we had one of the most rapid rises in interest rate that we've had in history. In all likelihood, that's not an event that's going to repeat itself.
Right.
And so if we have like a relatively high level of, kind of payouts on those bonds and a low likelihood that we'll have a repeat of rapid interest rate increases, boy, that's kind of Goldilocks for, a time to be entering the bond market.
Yeah. So in summary, in conclusion for today's episode of the Market Minute, when we build a retirement plan, it's designed to be an all-weather approach, right? It's designed to get us safely to our destination as optimally as possible. But we recognize that different conditions that might exist out there could necessitate, minor adjustments within the planning. But we're not abandoning the planning or smart retirement. That's actually part of the planning, smart retirement, to accommodate, market conditions that will necessitate some minor adjustments. And so if you are in that space where you say, I think I'm ready to maybe start de-risking, please reach out to your team here at Alliance Wealth Advisors, and we can have a conversation with you about specifically your situation, what that might look like, and how we might be able to be very unique to your needs, build that plan around your specific situation. Never abandoning the planning, never being in a position where we're saying, we need to change everything. It's like you said, Scott, minor adjustments, not jerking the steering wheel very fast. So with that backdrop, we appreciate everyone who joined us today on the call. We really love doing this every month with our clients. We look forward to doing it again in December. And until then, thank you, everybody.